Thanks very much, Chris, for that introduction, and for Bradley and CEDA for hosting this event, and People's Choice and Adelaide Uni for sponsoring it. Of course, while it may be the most important economic event, it's not the most important event happening in Adelaide today, because that would be what's happening this evening down the road at the Adelaide Oval. Although I'd have to admit, I'm a Carlton fan because I left Adelaide just before the Crows ever started. So, but at least the rest of you get to support a team which is at the top of the ladder rather than at the bottom of the ladder like I have to put up with. But as I said, we're not here to talk football, though I'm happy to talk about that. We're here to talk about economics today. And so what I would like to do is talk about some of the factors that the Reserve Bank takes into consideration in making its interest rate decision each month. And while they're both domestic and global, today what I'd like to do is talk about some of the global influences on domestic monetary policy. Oh, there we go. So as you are well aware, the Australian economy doesn't operate in isolation from the rest of the world, and that is clearly also true when it comes to monetary policy. So while the goals of monetary policy are very much domestic in terms of inflation and employment, the influences on the achievement of these goals are both domestic and global. So in talking about the global influences on the setting of monetary policy, I will make the probably obvious point, I hope it's obvious, that the policy rate here in Australia is at an historic low, in no small part because policy rates elsewhere in the world are also around historic lows. And so one of the things I want to talk about today is that why are global policy rates as low as they are? And part of the explanation is that to meet their policy goals, central banks in other advanced economies outside Australia have had expansionary settings since the start of the global financial crisis in 2007. Moreover, in the biggest advanced economies, so the US, UK and the Euro area, policymakers have provided further monetary policy stimulus through large asset purchase programs, that is mostly buying up government debt, which has seen central bank balance sheets increase significantly in size. But another part of the explanation is that the neutral level of the policy rate has declined in most countries, including here in Australia, and that was what attracted a fair bit of the attention that Chris was referring to earlier. That is, the level of the policy rate where monetary policy is neither providing stimulus nor restraint is much lower than it used to be. So central banks have had to set their policy rates even lower than that already lower neutral policy rate to provide the appropriate stimulus to their economies. So let me just give you a bit of a look at what I'm going to talk about. So I'll start by talking about 4 common global factors that have led to the expansionary monetary policy settings seen in most advanced economies for almost a decade, and use that to talk about why policy rates are so low. These 4 factors are present in Australia to varying degrees. I will then talk about the neutral policy rate and the fact that it's declined over the past decade, and then I'll finish with some comments on the influence of global financial factors on domestic monetary policy considerations here in Australia. So let me talk first about what those 4 global economic factors. So here they are. The subdued global recovery post-crisis, which is now 10 years old. The low level of investment around the world. Subdued wages growth despite low unemployment rates, and then how all of that feeds into the low inflation that we see today. So the first and most obvious factor influencing monetary policy settings globally is the financial crisis and its aftermath. So the large and rapid decline in policy rate settings in most advanced economies occurred in 2007 and 2008. So in most other parts of the world, interest rates were reduced markedly almost 10 years ago now. So over this period, many policy rates were reduced to close to zero, and subsequently, in a number of cases, even below zero. So the collapse in global output and trade at the end of 2008 was sharp and significant. And the severity of the episode was increased by the fact that it was synchronised across the global economy, all at the same time. The last quarter of 2008, you saw basically every economy in the world contract, and in some cases by a very large amount. But it's now 10 years since the onset of the crisis, and nearly 9 years since that when it was at its worst in the last quarter of 2008, yet we still see policy rates at their post-crisis lows. The Fed in the US has raised its policy rate in recent times, that's true, but even then only 4 times in quarter percentage point increments, so that the policy rate in the US has only now just reached 1%. That said, in the US, broader measures of financial conditions suggest that their policy or financial conditions aren't tighter since the Fed started increasing its policy rate 2 years ago. That is, they've raised their policy rate, but financial conditions haven't even tightened. Long-term bond yields in the US and the US dollar exchange rate are both no higher than when the Fed first increased its policy rate. Corporate bond yields there remain near historic lows, and US equity prices are considerably higher. So the effects of the financial crisis on most parts of the advanced world have been very long-lasting. Global economic growth has mostly fallen a little short of expectations for all of the past decade. As a result, even with those expansionary monetary policy settings that we see, aggregate global growth has been only average over this time, but not better than average, which would have been what we were after given how large the loss of output was back in 2008 and 2009. So as I'm sure you know, Australia didn't suffer from the same decline in output that many other advanced economies underwent, and this slide gives you some comparisons as to how different economies have gone since 2007. In the level of GDP in Australia, it's 27% higher than it was in 2007. In the US, actually, it's not 37, it's only 13% higher. And in the UK, it's 10%. And in the euro area, they only just got back to where they were in 2007 a couple of years ago. So we've had an okay amount of growth over the past decade, but in those other countries, if you look at what's happened over the past 10 years, growth has been very subpar, particularly given how large that contraction in output was. And it's only quite recently that forecasts for the global economy have been revised higher for the first time in many years. So we've had nearly a decade where forecasters have put out an expectation that the global economy is going to pick up, and then it doesn't. But for the first time in a long time, and so they have to revise their forecasts lower. But now, over the last 6-9 months, you've actually had people revising their forecasts up, not down. And this has reflected an upswing in industrial production and exports across a large chunk of the global economy. And a critical question right now is whether this upswing is going to be sustained. So one of the reasons, if I go back to these 4 factors, one of the reasons that global growth after the financial crisis has been only moderate is the second of these factors here that I'd like to talk about, which is the low level of business investment over the past decade. So many of the preconditions that historically led to a pickup in business investment have been in place. We've had low policy interest rates, there's been low borrowing costs for most businesses, there have been strong corporate debt markets, but we haven't had any material growth in investment. So something has clearly been missing that has prevented those positive preconditions from generating an upswing in business investment. So one obvious candidate is uncertainty about future demand, uncertainty about how the global economy is going to go in the future, or as it is often referred to, animal spirits. So to some extent, this lack of animal spirits has been self-fulfilling. If businesses are not confident about whether there will be enough demand in the future to justify more investment, they hold off spending on investment, and then lo and behold, output isn't as strong as they thought it was. As the global economy has become more integrated, there seems to be a more important common global element in animal spirits. And one driver of this may well be that we have a lot of multinational firms making investment decisions across a number of economies all at the same time. In Australia, the investment dynamics have been clearly different. In marked contrast to the rest of the world, business investment in Australia over the past decade has been at historic highs rather than historic lows, largely as a result of investment in the resource sector. But now, resource investment has fallen most of the way back to its pre-boom levels. So we've now nearly unwound all of that large increase in resource investment that we've experienced over the past 10 years. And investment outside the resources sector in Australia has remained at a low level as it has in other countries. So the reasons why investment's been low elsewhere in the world seem to very much apply to why investment outside the resources sector here in Australia has also been low. That said, it has actually grown modestly here over the last couple of years. In recent months, there have been some positive signs on investment spending in a number of countries around the world. If this is sustained, then it's possible that the animal spirit switch from being self-fulfillingly negative to self-fulfillingly positive. As we see signs of investment picking up this year in some other countries, there is an increased chance that this may be reflected in Australia too. And a gradual pickup in investment is something that's embodied in our current growth forecasts. The third factor I'd like to talk about is low wages growth. So here's a picture of wages growth in the US, the UK, Japan and Australia over the past 20 years or so. And you can see, most obviously, in Japan it's just been low forever, but outside of Japan you can see in the US, the UK and here there's been a marked step down in wages growth. And this is occurring despite very low unemployment rates in countries such as the US, Germany, Japan and the UK. The unemployment rates in those countries are at levels that have historically been associated with an acceleration in wages growth, but we're not seeing it here, we're not seeing it yet. And the Governor talked about this in a speech late last year. My counterpart Andy Haldane at the Bank of England recently discussed some of the possible explanations for this stubbornly low wages growth and concluded that in the end we don't yet have a particularly good explanation for it. That said, one of the things I learnt when I was studying economics here, possibly from Chris, was we do know that the labour supply curve ultimately does slope upwards. So what I mean by that is that if unemployment rate continues to decline in these countries, we have to be getting closer to the point where wage pressures do start to materialise, but we aren't seeing it yet. And wages growth in Australia, as this graph makes clear, is subdued as it is elsewhere in the world. One difference in Australia, though, which is worth noting, is that productivity growth here has generally been higher than it has been in these other countries in recent years. So as a result, in Australia, there has been no growth in unit labour costs, that's wages adjusted for productivity, for the past 5 years. So where the level of unit labour costs today in Australia is exactly the same as it was 5 years ago. That's not true elsewhere in the world, where unit labour cost growth has been quite a bit higher because those other countries haven't actually experienced very good productivity growth at all. The fourth and last common factor I want to talk about is the sustained low inflation that has been evident globally for the past decade. So as you can, it's not quite so obvious here. You can certainly, if I took it back to through the 90s and the 80s, the current period looks particularly low. But you can see in the US, inflation's spent much more time below 2% than it has above 2% for all of the past decade. The same's true in Germany. In Japan, it's been stubbornly stuck at zero, despite the efforts of the Bank of Japan. And here, inflation's been very much at the low end of recent experience for a while now. Now, this low inflation is a direct consequence of the three previous factors I've just talked about. But in addition to those influences, there's been a continuation of the disinflationary pressure resulting from the integration of China into the global economy. There are some signs that that force, at least, is starting to wane, with producer prices in China actually growing following many years of continual and often quite substantial declines. In fact, one of the things I did when I was a research assistant for Chris back in my days here was actually when we were trying to actually find statistics on prices in China, I recall. But these days, we do have those numbers and they do show these quite substantial declines in China, but they actually have started to turn around over the past few years, which is different than what's been going on for most of the past decade. Throughout the past decade, though, globally, expectations about future inflation have remained broadly anchored, which at times has helped to stave off a shift towards deflation. So while inflation is low here, with the exception of Japan, we haven't actually seen deflation in any of the major economies. So these four factors, the subdued global recovery, low investment, subdued wages growth despite low unemployment rates, and low inflation, are the primary explanation for the very stimulatory policy settings we see globally. So what I've got here are the monetary policy interest rates in Australia, the Euro area, the US, and Japan. So Japan, most of the time, is actually at zero or just below, which is a bit hard to see there. And in the US, for most of the past decade, up until quite recently, it was at zero. And in the Euro area, it's actually below zero, which wasn't something you probably learnt when you're in your undergraduate days, that interest rates could actually be below zero, let alone policy interest rates. But lo and behold, we've had negative interest rates in Europe for a few years now. We've had them in Japan, and we've got them in other parts of the world as well. So the fact that they are at such low levels in those major advanced economies has a material influence on why the policy interest rate in Australia is also at an historic low. Beyond these factors that I've just discussed, another significant factor contributing to the low level of policy rates globally is that the neutral policy rate in many countries have declined over the past decade. So let me talk a bit about that. The neutral interest rate provides a benchmark for assessing the current stance of monetary policy. If the real policy rate, that is the cash rate, what I've got here, less inflation expectations is below the neutral rate, then monetary policy is exerting an expansionary influence on the economy. If the real policy rate is above the neutral rate, then policy is exerting a contractionary influence on the economy. So the neutral rate is often associated with the turn of the 20th century Swedish economist Wicksell and was picked up by Keynes. The previous Governor Glenn Stevens discussed the neutral rate in the Australian context a bit more than a decade ago. And as you may have read in the paper, there was a discussion of the neutral rate at the most recent board meeting, as detailed in the minutes that we put out earlier this week. Now, despite all the kerfuffle around that, there was no significance should be read into the fact the neutral rate was discussed at this particular meeting. Most meetings, the board spends some time discussing a policy relevant issue in more detail. This time around, it just happened to be the neutral rate. We work out what are those topics going to be sort of 6-9 months in advance, so there really was nothing special about why it was this month and not some other month. Anyway, that said, let me go on to talk a bit more about it. The neutral rate aligns the amount of saving and investment at a level that is consistent with the goals of monetary policy, that is full employment and stable inflation. So it's where the policy rate would settle down in the medium term when everything in the economy is going along how we would like it to go. So accordingly, most explanations of the neutral rate start with factors that influence savings and investment. Developments that increase savings tend to lower the neutral rate. Things that increase investment will tend to raise it. So there are three main factors that affect the neutral rate in Australia. One is the economy's potential growth rate. That's how fast the economy can grow without generating inflation pressure. The degree of risk aversion in the economy, and then thirdly, global factors. So one of the main determinants is the economy's potential growth rate. If we have a high potential growth rate because we have strong productivity growth or population growth, then that generates more demand, generates more investment, and prospect of high income reduces the incentives of households to save. That tends to push the neutral rate up. So if the economy's got a higher potential growth rate, higher neutral rate. The potential growth rate in the economy tends to evolve quite slowly, so we don't expect that to move the interest rate round all that much from quarter to quarter. But another influence on the neutral rate is the risk appetite of firms and households and the way risk is being priced into market interest rates, and that can move rapidly. When risk aversion rises, firms require more compensation to make longer-term investments with an uncertain return. Households are going to be more likely to save more. And those two factors both lower the neutral rate as any given level of the policy, so that any given level of the policy rate is less expansionary because of the increased risk aversion. If there is an increase in risk aversion, it is also likely that there will be a widening in the spreads between the policy rate and market rates. So a widening in the spread between the cash rate here and, say, the mortgage rate in the economy or the rate that businesses borrow at. So a given market interest rate will correspond to a lower policy rate if spreads widen, and that will further lower the neutral rate. And then finally, in an open economy like Australia, where capital can move freely across borders, global rates will also influence domestic interest rates. So that means movements in the neutral rate in other countries are going to also affect the neutral rate here in Australia. So how do we actually calculate this thing? Because it's not actually directly observable. So there are a number of different ways of doing it, from the behaviour of market rates and other economic variables. And so here's some estimates that we've come up with for the neutral rate. So the red line in the middle is the average, but then the shaded areas give you the sort of range that this thing the estimates can move in, let alone knowing whether that's actually what it is. So there's a fair amount of uncertainty about this thing. It's not that precise. But what all of the estimates show is that the neutral rate now is a fair bit lower than it was in 2007. How much lower depends on which estimate you want to use, but whichever way you want to estimate it, it's a lot lower now than where it was in 2007. So on this as well, I've got the cash rate adjusted for inflation, so the real cash rate. So when that black line is above the red line, policy is contractionary. When it's below the red line, policy is expansionary. And if you look through that, it pretty much lines up with what most people would have thought at the time. So what that shows is that in the early 2000s, in 2008, and for the past 5 years or so, monetary policy has been expansionary. The estimates of the neutral rate, if you look there, also suggest that from around about the mid-90s through into 2007, it was actually pretty stable. And in Glenn Stevens' speech that I mentioned earlier, he noted that the cash rate at the time he gave the speech, which was 2004, was probably somewhere around 2.5% to 3.5%, which luckily, it's not always the case that when you say something and you go back and estimate it 15 years later, it actually turns out to be about right. But in this case, it actually is consistent with the estimates shown here. So the graph, as I said, shows a clear step down in all the estimates of the policy of the neutral rate in 2007-08, and that has probably drifted lower since. It suggests that the neutral rate today is currently around 150 basis points. That's 1.5 percentage points lower than it was in 2007. And that can largely be accounted for by a slowdown in productivity growth and an increase in risk aversion. So our best guess of best estimate, of potential growth rate for Australia has declined by around about 0.5 percentage point from the mid-90s. So potential growth in Australia now maybe around about 0.5 percentage point lower than it was in the mid-90s, which mostly reflects slower labour force growth. The slowdown in potential growth has probably translated about 1-for-1 into a decline in the neutral rate, though the decline has been gradual. The sharper decline that you can see in 2007-08 can most easily be related to the sharp increase in risk aversion with the onset of the financial crisis. And this increased risk aversion probably accounts for most of the large fall in estimated neutral rates in Australia and in other countries that occurred at the time. And that's also been reflected in an increase in spreads between the cash rate, the policy rate, and borrowing rates like the housing mortgage rate and business borrowing rates. Although these effects are hard to quantify, the fact that those spreads are going up has almost certainly lowered the neutral rate. If I should do it in a global context, what I've done here is shown some estimates. The estimates for Australia are our estimates, and those for Canada and the UK and the US and Europe, which are roughly the same in each case, are estimates from other institutions. So you can see there that on average, the neutral interest rate estimates for Australia are similar to those in the UK and Canada, but higher than those for the US and the Euro area. As is the case for Australia, the estimates were fairly stable until around about the mid-2000s and have fallen since then. And the decline in all cases was particularly sharp in 07-08, and again most likely reflects the increase in risk aversion at the start of the financial crisis. And because the determinants of neutral rates tend to be highly correlated across the advanced economies, it's actually hard to distinguish between international influences and domestic influences on it, but it's highly likely that the decline in neutral rates in other countries has contributed to a decline in Australia's neutral policy rate. So in short, the policy rate in Australia is low because the neutral rate is lower than it used to be as a result of both international and domestic developments. That means that the current setting of the cash rate, which is 1.5% today, is not as expansionary as a cash rate of 1.5% would have been in the 1990s or in the first half of the 2000s. So another way of putting that is, a cash rate of 1.5% sounds very low, but if I go back to the previous slide, you can see that the gap between the black line and the red line has been larger in the past than it is now. So the policy settings are stimulatory now with a cash rate of 1.5%, but not necessarily, they're no more or less stimulatory than they have been in times in the past. Looking ahead, the neutral rate both here in Australia and as well as in other advanced economies is likely to remain lower than it was in the past. It is mostly because potential growth rates look like they're going to be lower for a while. It is plausible that the degree of risk aversion, which caused that spike lower in 2007, might reverse in time, which would receive the neutral rate rise from its current low level. But other developments may be more permanent. In addition to the neutral rate declining, policy rates in other countries have been set even lower than that low neutral rate to provide the appropriate stimulus. On top of that, in a number of the major economies, policy is more expansionary than indicated by just the level of the policy interest rate. So what I've got here is the size of central banks' balance sheets relative to the size of their economy. So you can see the Bank of Japan's balance sheet is almost the same size as the whole of the Bank of Japan, of the Japanese economy. And you can see the rise in the size of the balance sheet in the euro area and in the US. But you can see that here our balance sheet has remained roughly the same size as it has been for a long time. There's a little bit of a rise in 2008, but that was subsequently reversed fairly quickly. Why have these balance sheets gone up? That's because those central banks have been purchasing assets mainly in the form of government debt, with the Bank of Japan being the biggest purchaser of government debt. So the fact that monetary policy settings are more expansionary in the rest of the world than in Australia, both through lower policy rates and balance sheet expansion, has been putting upward pressure on the Australian dollar. Capital is attracted here by the higher rates of return on offer, and that's likely to cause the exchange rate to appreciate. So while an easier monetary policy elsewhere in the world, so when these guys ease monetary policy, that makes their economies grow faster, hopefully. That's good for the Australian economy, and appreciating Australian dollar works against that. So to put it in economic terms, there are offsetting income and substitution effects for the Australian economy. Whether in net terms it's positive or negative for Australia is an empirical issue. And generally the evidence suggests that widening interest differentials do lead to an appreciation of the Australian dollar. So that does counteract the benefit to the Australian economy of faster global growth. It's conceivable that unconventional monetary policy, which is what this is often described as, may have a larger financial impact than movements in interest rates. That is, the effects of balance sheets expansions on the exchange rate may be larger, while the effects in terms of higher output, in terms of stimulating growth in these economies, may be smaller. Again, it's an empirical issue. Moreover, central bank asset purchases generate cross-border capital flows from investors seeking higher returns. Some of that we do see in a higher currency, but some of those cross-border flows are not quite so obvious. Investors often tend to hedge their exchange rate exposures to protect from exchange rate movements. So as these investments increase, there is more demand for such hedges, which causes the cost of that hedging to rise. And a direct measure of this is something called the cross-currency basis. So the most obvious example is out of Japan. There's a very wide yen basis, mostly because there's a lot of money coming out of Japan. Some of it comes directly and buys Australian assets, pushes up the Australian dollar, but some of it, a large chunk of it, is actually hedged so that they protect themselves from the exchange rate, and you see that in a very wide yen basis. It's actually, to some extent, a good thing that those investments are hedged, because if they weren't, we'd see even more of the effect of those capital flows in the exchange rate from the Japanese investors in particular placing their funds in Australia, and the Australian dollar would have appreciated by more. So that hedging has served as something of a shock absorber for those cross-border flows. But that aside, those expansionary settings of monetary policy globally clearly have had a material influence on domestic monetary policy settings through the impact of capital flows on the exchange rate. And a French economist, Helene Ray, has recently described this state of affairs as a monetary dilemma. So independent monetary policies, she says, are possible if and only if the capital account is managed. That is, we can only run an independent monetary policy in Australia if we have some control on the capital flow coming into the country. I don't think the situation is quite as stark as Helene says. There is still a substantial degree of flexibility to set domestic monetary policy appropriate for domestic conditions. But I would certainly agree that the monetary policy decisions of other central banks are a significant factor to take into account in our monetary policy deliberations here. So another way of putting it is that we don't have the independence to set the neutral rate, which is significantly influenced by global forces, but we do have the independence to set where we set our policy rate relative to the neutral rate. So let me finish up and to conclude. I've outlined today a number of the channel of influences that global developments have on domestic monetary policy settings. Some of these forces are transmitted through the real economy in terms of things like investment and wages, but some through financial channels. The effects of these global influences on the Australian economy have been material. The global economic environment and global policy settings that have been in place for the past decade have contributed significantly to the monetary policy settings in Australia that we have today, and will continue to do so for the foreseeable future. Now, currently, financial markets don't expect any further lowering of policy rates in the major economies, nor any further expansion in policy settings. Hence, the downward pressure on our domestic policy settings here from this source doesn't look like it's going to get any worse in the foreseeable future. But the four common factors, low investment, low inflation, wages, and the recovery from the crisis that I highlighted in the first half of my speech, they're still present. There are some tentative signs that they are abating, but the evidence is inconclusive as of today. As I said earlier, the Fed has raised its policy rate very gradually over the past couple of years, and last week the Bank of Canada increased its policy rate to 0.75%, 0.75%. So just as the policy rate in Australia didn't need to go down to the very low levels seen in other parts of the world, the fact that other central banks increase their policy rates doesn't automatically mean that the policy rate here needs to increase too. The policy rates in both the US and Canada still remain below that in Australia. Ultimately, in Australia, as is the case elsewhere, policy rates are set at the level assessed to be appropriate to achieve the domestic policy objectives. So while global influences, including monetary policy settings in other economies, have a significant impact on that assessment, they are, in the end, only one of a number of considerations to be taken into account. So let me finish there and not stand in the way of lunch, but hope that gives you some idea of some of the global considerations that we have to take account of in setting the domestic monetary policy decision. So I'll stop there, let everyone have some lunch, and then I think, Chris, we're coming back for some questions.